Okay, welcome back. Welcome back um, to our next video in a series of teachings and explanations and demonstration of our farm accounting system. Now, in the previous video, we looked at the chart of accounts and how accounts are structured. All right, we looked at it in very, very much detail. And we are now going to take the next step. And what other step is there than using those accounts to record transactions in the system? All right. And this is where everything starts to come together. All right. Now, the transaction register. This is where we are going to do all our transaction recordings. Every financial activity in the farm will be recorded here. So this includes purchases, it includes sales, it includes expenses, and any movement of money or any movement of value. All right, for as long as it has monetary value, it is going to be recorded here in the transactions register. All right, so everything that you saw in the chart of accounts is now going to be used here. Now, every time that you record a transaction, you are going to select an account from the chart of accounts. All right. So we have seen the chart of accounts. It comes with a lot of different accounts, and each one of them has an account code, and that is what we are going to use in the transactions register. So you do that by coming at the account code and actually selecting it here, and then you will see that all the accounts which are in the chart of accounts will be populated here. Even if you add your own within the parameters that we have seen in the previous video, you are also going to see them accumulated here as well. Our system has been set up to do some of those things automatically. All right. So instead of typing the names in manually and the categories and stuff, you are going to use the predefined account codes, and then the system will put in the name automatically as well as the category of that account as well. So this ensures consistency, it ensures accuracy of the system, and it also ensures correct reporting. All right. Now, let's quickly talk about how transactions are recorded. Remember, we have said that each transaction must have two sides, a debit and a credit. All right. So each row represents one side of a transaction. And when we do that, a double entry is ensured. So whenever you post anything, you need to ask yourself, we said, that where is the value coming from and where is the value going to, right? So that is what we do. So in simple terms, one account receives the value and the other account gives the value, all right? So in this system, we use two terms to determine which one receives and which one gives the value. So, and that is determined under the transaction flow. So when you come here, you see the two terms. You see received and you see source. So that means that received will be the account that will increase, all right? And obviously source will be the account that will be decreasing, because it is the value is being taken out of the source account into the received account. That's all you need to remember, basically, because when you remember that and you know and you place you place the correct flow in the correct account, then your books are going to work very, very well. All right, they're going to come together very, very well. Now, let's quickly, you'll see that the transactions register is made up of different columns. So let's quickly look at some of the key columns that you are going to use. And it is, we see the date, so when the transaction happened. We see the reference, that's the unique ID that you give to that transaction. and then the description, so what the transaction is about, and then the account code, which will be selected from, as we said, from the chart of accounts. And then when you put in the account code, the system will automatically complete the name and the category. All right. So, and then you set the transaction flow, and we said very, very important, whether it's received or whether this account here is the one that is the source of the movement. And then you put in the amount. All right. So once you do that, the system automatically puts in the account name, as we mentioned, as well as the category and some other details. So your main job is just to enter accurate data. Just make sure that what you enter is accurate. The flow is accurate. The account code is accurate. And then, then things get into alignment. All right. So what are we waiting for? Let's go ahead and record our first transaction. All right. So for the first transaction, the owner invests $50,000 into the business. Now, from the chart of accounts, we know that bank is an asset. So we determine first of all which two accounts are affected. So obviously, the one account is the bank account, and then the other account is owner's capital. All right. So bank is an asset, and owner's capital is equity. We saw that bank is an asset, and then owner's capital is an equity. All right. So how do we record that transaction? So the first line, let's first of all, it's up to you how you want to put it, but for consistency and let us first of all always record the source. Let us put the source account first in the first line. All right. So between these two accounts, which one is going to be the source account? So meaning, from which account will this value flow? From where will it flow? So let us first of all put in the date, and then we say that enter the date in this format, month first, and then the date, and then the year. So January 1, 1, and 2026. All right. Let's go ahead and just drag that down as well, because we're going to put in the first and the second line. We're going to allocate them to the same transaction right now, immediately. So, and then the reference, we can put in capital 001, all right, capital 001. So that is the first capital injection. That is the first capital injection. So same reference, both lines, same reference, same description. So this would be owner's capital introduced. All right. Owner's capital introduced. And then there we go. Now comes the most important thing. So which account codes are we going to use? We said we're going to use the bank and we're going to use the owner's capital. So which account is going to be the source? From where will this flow? So it is going to flow from the owner's capital first. We said the owner's capital is an equity, so we go to equity, capital, owner. And once you do that, then owner's capital is automatically inserted, as well as the category, which is equity. And then we can also just do the same for the receiving account, which is the bank. So the bank, and da-da-da, there it goes. Now, we said this first one is the source. And once we put in source and we put in the amount of 50,000, then the system automatically allocates that as a credit. And we put this as the receiver of 50,000. And our double entry is put in place. All right. Now, do we allocate this to any enterprise? No. That's a general, it applies to the entire farming enterprise. No VAT, percentage, and nothing. So this is not an expense. So it says not applicable. And you'll see here that with every transaction that we enter, the system also creates a unique key if you want to go and do reference. All right. Okay. And to also prevent double double entry of the same transaction. Okay, so there we are. Now let's quickly go and see what effect that has on the dashboard. You see, no revenue yet because no income, no expenses, no profit, but the bank balance is seated with a $50,000. All right, and now we have said that all these transactions are being pulled into the all transactions automatically. So let's see whether this will appear in all transactions. And there we are. It is appearing there, and the other registers, like the financial registers and stuff, they are pulling information from this one. All right, not from the one that we are entering into, but from all transactions, because this is where all the transactions are brought together. They are being pulled in here together. All right, so let's quickly see our financial statements. Let's see our trial balance. Oh yeah, it balances 50,000 debits, 50,000 credits. And then the income statement, we see here that there is nothing because there was no income yet. And the balance sheet also balances at the bottom here. The total assets equals to total assets plus total liabilities plus equity. All right, so we see 50,000 as an equity, owner's capital. It is put in there automatically. And also the bank also has 50,000 here, which is our assets, therefore balancing the assets and the total liabilities plus equity. So we are good. We are good so far. We are on the right track. All right. Now notice here that we are using the accounts that we defined earlier in chart of accounts. Now let's go and buy livestock in the next video. Let's look at the next transaction of buying livestock. I will see you in the next one.